Bernard Madoff defrauded investors of an estimated $64.8 billion, running what the SEC called a criminal enterprise built on a foundation of deceit. For decades, he operated an investment firm that was, in reality, a massive Ponzi scheme, devastating thousands of lives and shattering trust across the financial world. But how did one man manage to fool regulators, sophisticated investors, and even his own family for so long? This wasn't just about stolen money. It was a systematic exploitation of the very systems designed to protect us. We'll trace the meticulously constructed facade, the critical moments it nearly crumbled, and the eventual, spectacular collapse. And stick with me, because the last part of this is the piece almost everyone gets wrong about financial fraud, and it's the part that determines if a system truly learns its lesson. Bernard Madoff's Ponzi scheme stands as one of the largest financial frauds in history, exceeding $65 billion. Yet its true insidious nature lay not just in the sheer scale of the theft, but in the meticulous, decades-long cultivation and betrayal of trust among a sophisticated network of investors and financial institutions. For years, Madoff maintained an aura of invincibility, a reputation carefully constructed through consistent, if suspiciously steady, returns that defied market logic. His fraud wasn't a sudden implosion, but a slow-burning erosion of capital, meticulously hidden behind layers of fabricated trades and false account statements. This case explores how Madoff, a former chairman of the Nasdaq stock market, leveraged his esteemed position within the financial elite to orchestrate a deception that ultimately spanned 4 decades, from the early 1970s until its collapse in December 2008. We will examine the critical vulnerabilities within the regulatory framework that allowed such an extensive operation to persist unchecked, despite numerous red flags raised by whistleblowers and financial analysts. This story isn't just about a con artist. It's about the systemic failures that enabled him to exploit the very bedrock of financial trust, leaving a devastating legacy for thousands of victims worldwide. Our journey begins with the initial whispers of suspicion and the seemingly unshakable facade Madoff presented to the world, exploring how he cultivated an exclusive clientele who believed they had access to an unparalleled investment opportunity. How did a man with an open secret maintain his facade for so long, even serving as chairman of Nasdaq? Bernard Madoff was not just another Wall Street player. He was a respected figure, a former Nasdaq chairman, and the founder of Bernard Madoff Investment Securities LLC, or BLMIS, established in 1960. Initially, BLMIS operated legitimate market-making and proprietary trading operations, building a reputation of reliability. However, beneath this veneer, Madoff cultivated an exclusive investment advisory business, promising unwavering 10–12% annual returns regardless of market conditions. He claimed to employ a complex, proprietary split-strike conversion strategy, an option strategy so intricate it was virtually untraceable, adding to its allure and perceived sophistication. This secrecy, combined with an exclusive word-of-mouth referral system, created an aura of invincibility. Investors, including high-profile celebrities and institutions, were desperate to gain entry, often boasting of their in with Madoff. For instance, according to court documents, one prominent investor described Madoff as a financial god, a sentiment echoed by many who eagerly handed over their fortunes. The question then becomes, why did so few look too closely at the man who seemed to defy gravity? How did a firm handling billions in assets manage to operate for decades with virtually no credible external oversight? Bernard Madoff's Ponzi scheme thrived in plain sight, largely due to a deliberate operational setup and a shocking lack of scrutiny. The fraudulent operation ran parallel to his legitimate market-making firm, occupying a separate, locked 17th floor at the Lipstick Building in Manhattan. Here, a small, loyal team, including Frank Di Pasquale Jr., Madoff's chief financial officer, processed falsified trading confirmations, account statements, and regulatory filings designed to mimic actual investments. Di Pasquale, according to court documents, meticulously created millions of fake trades, often backdating them for years. The most egregious oversight came from BLMIS's auditor, Freeling and Horowitz. This firm, operating out of a strip mall in New City, New York, was later revealed to have just one active accountant, David Freeling, who essentially rubber-stamped Madoff's books without proper review. Madoff, meanwhile, skillfully used his reputation and a subtle form of intimidation to deflect inquiries. Questioning his operations, particularly his consistent double-digit returns regardless of market conditions, was often met with an icy rebuff, cultivating an environment where challenging the financial giant was simply not done. This deliberate insulation and a complicit or inept auditor allowed the scheme to grow unchecked for years. But even with such a meticulously constructed facade, how did the regulatory bodies miss what was unfolding? For 16 years, the Securities and Exchange Commission, or SEC, received multiple detailed warnings about Madoff, yet consistently failed to act. As early as May 1999, financial analyst Harry Markopolos, then working for a competitor firm, became suspicious of Madoff's consistently high and stable returns, particularly as they defied market volatility. Markopolos, a certified fraud examiner, found Madoff's claimed split-strike conversion strategy mathematically implausible, arguing that such large options trades would invariably move the market, making the claimed consistent profits impossible to achieve. From May 2000 to December 2005, Markopolos, along with his team, filed at least 5 formal complaints with the SEC, providing meticulously detailed evidence, including a 21-page memorandum in 2005 titled, "The World's Largest Hedge Fund is a Fraud." Despite these extensive warnings, the SEC's subsequent investigations were repeatedly deemed insufficient. According to a 2009 Inspector General report, SEC examiners never took the necessary steps to investigate beyond Madoff's highly evasive answers, failing to demand genuine trading records or to critically examine his small, obscure auditing firm. This repeated institutional failure allowed the fraudulent operations to continue unimpeded. But as the scheme grew, the question remained: who exactly was losing money and how much? The true scale of Madoff's fraud was a phantom, yet its collapse had very real, devastating consequences for thousands. The elaborate illusion finally shattered with the onset of the 2008 financial crisis. As markets tumbled, investors, facing their own liquidity challenges, began to request redemptions. Madoff, who had promised consistent returns for years, was suddenly confronted with over $7 billion in withdrawal requests he simply could not fulfill. On December 10, 2008, Madoff confessed the truth to his sons, Mark and Andrew Madoff, stating that his entire investment advisory business was one big lie. The sons immediately informed authorities. The subsequent investigation revealed that while client statements reported a staggering $64.8 billion in value, the actual out-of-pocket losses for victims, the money they directly invested and never recovered, were closer to $18 to $20 billion. This colossal fraud affected individuals, charities, and pension funds globally, including prominent feeder funds like Fairfield Century and Kinggate Global, wiping out life savings and philanthropic endowments. But what was the singular factor that allowed this deception to persist for so long? The astonishing reality is that Madoff's primary investment advisory business, the core of the Ponzi scheme, never executed a single trade on behalf of its clients for nearly 40 years, despite claiming to manage billions. This entire operation, from its early 1970s inception, was a classic Ponzi scheme, relying solely on new investor money to pay returns to earlier investors, not through any actual investment strategy. This simplicity was hidden behind a facade of complex financial jargon and an impenetrable black box trading strategy. Madoff's extraordinary charisma and impeccable reputation within the financial community were his most potent tools, allowing him to cultivate an image of unparalleled success that blinded both sophisticated investors and regulators for decades. This network and the trust he inspired were the real secret sauce, more so than any intricate financial wizardry. Ultimately, the illusion collapsed when the flow of new money could no longer cover the redemption demands. On March 12, 2009, Bernard Madoff pleaded guilty to 11 federal felonies, including securities fraud, and was subsequently sentenced to 150 years in federal prison. He died in prison in April 2021, marking the final chapter in one of history's most profound financial deceptions. The fact that the scheme persisted for so long, without generating a single legitimate trade, underscores the power of perceived credibility over actual performance. Ultimately, the case of United States v. Madoff stands as a stark illustration of systemic failure, a confluence of regulatory oversight lapses, unchecked trust within exclusive investment circles, and a profound lack of independent due diligence. On March 12, 2009, Madoff pleaded guilty to 11 federal felonies, including securities fraud, money laundering, and perjury. On June 29, 2009, Judge Denny Chin sentenced him to 150 years in federal prison, a sentence that reflected the devastating impact on thousands of victims and the unprecedented scale of the financial crime. The Madoff case became a catalyst, fundamentally altering how financial regulators approach complex investment structures and reinforcing the critical importance of skepticism, even in seemingly legitimate high-yield environments. Given the complexities and the widespread impact, what specific safeguards do you believe are still missing in financial regulations today that might prevent another Madoff-level scheme? Share your thoughts below. For more deep dives into the legal intricacies of landmark financial crimes and their lasting impact on jurisprudence, subscribe to the channel. And if this examination of financial fraud intrigued you, I encourage you to watch my detailed breakdown of the Enron scandal next, which reveals another facet of corporate deception. This video presents publicly documented information. It is for educational purposes, not legal advice.